Avanti feeds from Ashish Chok's tweet. It's almost 50 times, right? It was a market cap of 100 crores and now it's a market cap of 5,500 crores. But there can be only one Avanti feeds, right, in every bull market, or can there be more? Let's ask Ashish Chok. Let's invite Ashish Chok on stage, please. Okay, so once again, the same topic as we were discussing. You teach a hungry man how to fish so that he doesn't ask you for a fish every day. He can do it all by himself. Ashish, thank you so much for taking part in Investor Camp. You don't have a presentation, but you know what? I just wanted to ask you a couple of questions. You can ask him privately what's the next stock to buy, but here we'll just do some investment thesis. Ashish, what's the basic process that you go through? I've been told that you only look at bseindia.com. Whatever research you do is just available on that exchange website and you don't look anywhere else. Is that true? And I mean, what's your overall thesis in terms of identifying these multi-baggers?
Good morning, everyone. You mentioned about Avanti feeds. I would like to put a note of caution. Against one Avanti feed, there is going to be a GVK power also, which doesn't do anything in the last 5 years, or there could be a Deccan Gold mines also, which hardly moves. So, this is a kind of thesis where the idea is to invest in 10 stocks. I'm just giving you a hypothetical figure. Now, what will actually happen is, out of these 10 stocks, 3 or 4 may not perform, or they may perform along with the markets. You have to be prepared for, say, 1 or 2 stocks which become absolutely zero. Practically, it has, touch wood, not happened to me, but there could be scenarios where the stock gets delisted from the exchange. But then you have to bank upon the 2 stocks which can potentially be 20, 30, 40 baggers. Now, the challenge is that generally what happens is people buy a GVK at 9 rupees and a Avanti feed at 100 rupees. They end up selling Avanti feed when it goes to 150 rupees and end up holding GVK power even at 5 rupees. So the thesis is that you have to evaluate what the company is doing, and you have to sometimes ignore the short-term negatives in terms of some event-based negatives which come up in companies, or some quarterly numbers which are maybe below analyst expectations or below say the last quarter. So you have to sometimes ignore those and understand the reason for those negative numbers, so that you get conviction to hold the stock. So that is the basic thesis behind this. So answering your question, Anuj, I am generally looking for, in one line if I have to say, good businesses which are managed by ethical people, and more importantly, which are available at reasonable valuations. Now, these things are very easy to say, but to identify them takes a, you may not get this ideal situation always. So one scenario is that, try to look for companies which are in sectors which are out of favor, or companies which are out of favor. But, these are negatives which are curable negatives. These should not be, negatives which cannot be cured. So sometimes because of these negatives, and because of the fact that these negatives don't seem curable over the next, say, 1 quarter or 2 quarters, sometimes these stocks get hammered to extremely low levels, and there, to judge whether to buy the stock at those levels or not, you have to carefully look at the valuations of those companies. I'll just give you a historical example. There is this company called Balaji Amines. What happened is that this company came out with an expansion plan, and that expansion could not go through in the time which they had specified because of some issue with the process. And the second thing is that they invested some money in building a hotel. Now, these two things were constituted by the market as something, one, the management is not putting the money to good use. And second is, it created some kind of a doubt about the execution capabilities of the management. But, the stock came to a point where the stock was available at about 2 to 3 years of cash flow. And that cash flow was coming from the existing business. So it came to a point where even if you had invested in that company at that level, it came down to a level of 35 to 40 rupees. And at 40 rupees, it was roughly 2 years of cash flow the company was available. So there you have to take a judgmental call. Markets has hammered that company to a level where, it is available at extremely juicy valuation. Even if the money which they had put in the hotel, and if you take that value as zero, you are still getting the business at 2 years of cash flow. So it made sense to, buy that company and not get swayed by what the market was thinking at. So you get these kind of opportunities. Sometimes if you look around, if you are, I am a student of valuations. So I look at companies where, they've been hammered down to levels where the valuations start to look very good. Now, there is another category of companies, companies which are doing well, which are making good profits, good dividend payouts, high promoters holdings, but markets are ignoring those companies only because of one reason: the promoters are not too forthcoming. In a number of cases, there are promoters who want to focus on their business rather than doing investor con calls or talking to analysts. So these promoters are generally ignored by the markets. No analysts want to track those companies. So sometimes you get opportunities in that category of companies where the promoters are not forthcoming. But maybe when the company scales up to a particular size, that time maybe the promoters start talking to the analyst and press. So there you get investment opportunities. Another area is special situations. Now, what has happened is that a lot of these companies, big companies, have businesses which are not really related to their main business. Sometimes these companies would demerge this business into a separate company, and that new company would be too small in size compared to the bigger company. The recent example is Marico Kaya. Marico was a 7,000-8,000 crore company. When Kaya got delisted, it was just a 150 to 200 crore company. So somebody holding a 5% stake in Marico and FII, for him holding a 4 crore stock against a 400 crore stock does not make sense. So he would obviously be, looking to offload that stock. So sometimes you get these kind of opportunities in the market, and I think retail investors are the best to capitalize on those opportunities, because somebody managing a fund of 5,000, 10,000 crores may not be interested in a 1 crore or a 2 crore size of company in the portfolio. So retail investors can capitalize those opportunities, as and when they come.
Okay. You spoke about management quality, right? Porinjo is also someone who, talks about that. But he says that, his mantra is that he buys companies where the perception is that management chore hai. Right? He says that he only buys companies where, the perception is that it's a chore company. How does this perception build in, and how important is management quality for you? Does this change with the stock price behavior, or is that a factor?
Well, Anuj, I would say that that's a difficult part in investing. Management quality is very, very important in the entire investing process, because the kind of investing which we do, we just buy the stock and keep it for a few years, without worrying about day-to-day fluctuations in the stock price. Management quality is very important. But I think management quality is something which I believe has not been understood correctly in the market. I'll give you an example. At when the stock is at 1,000 rupees, Rico India is considered as a very good management. And when the stock falls to that fraud comes out and it falls to 200 rupees, then, people are just giving gali to the management.
Yeah, that's an outlier, like Satyam, Ashish,
Yeah, Satyam.
When a fraud happens, then but otherwise.
So my thesis is that, frankly, we have grown up here in India. Last 50 years, we have been seeing various companies, and the ecosystem which was built here. If you are running a factory, you have to feed 30 inspectors. So the businessman has no option but to take money out from the company. So that's the ecosystem we've lived through. So it is not that an ordinary Indian businessman wants to be dishonest, but he's made dishonest because of the ecosystem which was there. So right from the big groups to first generation entrepreneur would be taking out money from the company on some pretext or the other. So what happens is that stock price, when the stock price is low, that time the management would start to look bad. And the same management would start looking good when the stock prices move up. I have seen it in my experience that, if I identify a stock at very low levels, if everything is good, if the company is doing high ROE, very low PE, people will give an argument that, this management looks slightly dicey. So, my criteria of judging the management is not the perception part, but whether they are running the business in business well or not. So one is that they should be growing the business without much equity dilutions. So equity dilution is a very, very important factor for me. It has to be through maybe internally generated funds and some part of bank loan. So I give very high marks to a company which has not done equity dilutions over the last, say, 10, 15 years. They may not be interested in the markets, but the performance of the company has been growing on year, and because there's a expansion happening, the gross block is going up, sales are going up, profits are going up, and where the management has a skin in the game. They have to have a high promoter stake in the company. So that again is a very important factor for me. Then if the management is increasing its stake through creeping acquisition or buybacks, and how they are allocating the capital. So these are the factors, I would look for judging a management rather than, the stock price. So this is what I generally do to judge the management.
Okay. What's the next Avanti feeds, Ashish? Okay, I know you'll not talk about stocks, but at least some broad themes, and Ashish will talk about some themes, and my sense is that you'll be able to make out the kind of stocks that Ashish is referring to. Themes that you're backing right now, Ashish.
Okay, Anuj, I am generally looking out for companies with short-term negatives, as I told you. Now, there is one area where the companies have done expansion in the last few years. They have done capex. Now, what generally happens is when you do a capex, say building of plant and machinery, everything may take about 1.5 to 2 years. When the plant is ready, you don't start making money from day one. Plant may be operating at 20% capacity, there'll be a process problem, there'll be some teething problems. That plant may take 1 year to get established. But what happens in the interim is that your depreciation cost goes up. You may have taken some loans for making that plant, so your interest cost goes up. Because of these two things, your profits may come down. Now what happens is, if I take a scenario that the company has not done anything, vis-a-vis they have put a new plant. So in the first scenario, my profits would have been much higher because my depreciation is low, my interest cost is low. But even though I have done an expansion, my profits have become low. So what generally happens is that a lot of people sell the stock because of lower profits. So that is an area which I am looking at very carefully. Lower profits would mean lower valuations. lower stock price, but what will actually happen is, as there is a demand pickup or when the operations of the company stabilize, there could be a huge jump in sales and consequent increase in profitability. So that is one area or one sector which I am looking at, because when the profits are low, I am able to buy the stock at bargain prices. So that is what I am looking at. I don't want to pay a fair price or a higher price for a stock. I am looking for, I am basically a bargain hunter. I would like to buy the stock at much lower levels, of course, after doing my in-depth research. So that is one area, and the kind of companies which I am looking at can be maybe related to the building material segment, or companies which cater to the rural housing, low-cost housing. Mr. Modi has talked about increasing the farm income, doubling the farm income in the next 5 years. So there could be a big opportunity there. So look for companies. Here, these are companies where there are short-term negatives, because of which you are paying low price for acquiring that company. But as the situation improves, these companies can potentially make higher profits. The other is that we are going to see a lot of activity in the infrastructure sector. Now, what we have seen in the last 3 years is only conceptualization of ideas. The actual execution may take place in the next 5 years. And the kind of projects which the government is talking about, there could be a scenario that we are short of the company's capabilities doing those kind of projects. So that's another area which I am looking at very carefully. Here the problem is that companies which are good, which have got a good balance sheet, they have already multiplied 7, 8, 10 times in the last 3 years. But the challenge is to look for companies which can repair their balance sheet, where the money can maybe come in from the government, and where they have capabilities to do large projects. So that is one area. And second is that if you are bullish on infrastructure, you can also look at companies which are ancillary or proxies to infrastructure. These could be companies which are into renting of cranes, renting of infrastructure equipment, because these are the companies where they have done the capex for acquiring the cranes or the infrastructure equipment, and they are currently operating at low capacity. If you get a good valuation in any of those companies, I think that could be another area to look out for. The other is media companies, but media companies with lot of negatives. There may be companies, which have got one business which is not doing well, and the profitability of, say, one segment of the business is taken away by the loss which is generated in the other segment. So in case the management were to demerge these two companies, I think the one which is doing well can fetch much higher valuation compared to the combined worth of the company. So this could again be an area which can be looked at. Then another big theme could be, because of GST, could be value migration from the unorganized to organized sector. So look for listed companies in the sector where there is a lot of unorganized segment. So the areas which I can think of is maybe a plywood segment where there is a lot of unorganized segment, mainly in Jamunanagar. And the other sector which I can think of is writing instruments space, where there are a lot of small players who don't pay excise and sales tax, and they're able to sell their products cheap. So because of the GST happening, I think a lot of these listed companies in these sectors, there may be many other sectors. So just on the lookout for sectors where there is a high unorganized segment. So that could be again an potential area. And then say an e-commerce company. What is happening is that last 2 years or last 3 years, we saw these e-commerce companies trading at crazy valuations. Anybody with who used to hear that FIIs are not private equity players are giving money for the grocery sector, would form a grocery website or a portal and, just be running up and running with it just to get the valuation. So I think those things have come to a stop, which is good. But I think e-commerce is a sector which is going to stay here. It is not going to just vanish. So look for listed e-commerce players with established managements where there is a track record of the management in terms of taking care of the minority shareholders. So there may be opportunities available in those segments. So those are the few, broad themes which I am currently looking at.
Okay, I see a lot of young faces here, which is quite good. So I'm assuming that, a lot of you are starting for the first time. Some of you at least are. Ashish, for the first time investors, any do's or don'ts, any major points to remember?
Well, Anuj, I would say that, equity investing is nothing but a mind game. Okay, but the problem with this is that stock price movement messes up your mind. So I think it's a game of mind control and keeping your temperament under control. I think a good thing would be to not to really look at the stock price on a daily basis, but look at what is happening to the company and where is the valuation of the company going. So that is very, very important. And I think that, you don't really need to be a MBA from a IIM Ahmedabad or IIT graduate to do well in equity markets. My belief is that a person with average intelligence, but the right kind of temperament, can outsmart, anyone from a very good college background. So one thing to do is to develop an independent thinking. You must listen to everybody, but create your own opinion about which stock to invest and what is good for you. Me and Ashwini may be talking in tangents. Frankly, I don't understand what those technicals. So I am basically into more into value investing. It is more driven out of common sense approach to investing. And it's a very simple approach. So, you have to decide what is good for you in the long term and what is it that you are able to understand. So, one way to do that is to take responsibility of your actions. What happens is that I keep on hearing that I bought that stock on my friend's recommendation and the stock has come down. So, I think you must listen to everybody, but go back to your desk and do your own research. And I remember the time in early 90s where nothing was available, the balance sheet of the companies were not available, and we used to go to the library of Bombay Stock Exchange to fetch out balance sheet, take a photocopy and then read it. Now we are lucky that everything is available at the click of a mouse. So you have sites like Money Control where you don't have to pay anything and you get everything at the click of a mouse. So just go through the basic valuation parameters and if possible talk to the industry guys about that company. So industry guy then correlate the feedback which you are getting, your own research with the valuation. I think valuation is the key. The idea should be to buy the stock at cheapest possible price. Sometimes, you may have to wait for the price to come down to your level. Like what we saw in the last 5 days, people used to tell me that we don't get this stock, the stock has gone up. And many of these stocks corrected by 25-30% in a correction of, say, 3 to 4 days. So I'll always tell them that, if you have got an open mind and if you have the patience to wait, you will get your quantity at your price. Only thing is when there is a carnage happening, you should have the guts to buy that stock. So that is one. And most important thing is to focus on risk management, and that can only be done by focusing on valuations. People generally, work with the thought process that, okay, I'm buying this stock at 100 rupees. How high can it go? Can it go to 150 or 200 or 250? My thought process is that if I am buying this stock at 100 rupees and if there is a carnage which happens in the market, if something wrong goes with the company, how much money can I lose? So you have to look at your risk and also the potential reward. I'm not saying that don't look at reward, but first look at risk and then see whether, in case you are able to, if there is a 20% risk and 200% potential reward, so that makes a good investment candidate. So these are few tips for the first-time investors and also for investors who've been investing for a long time.
Okay, let me see how many boxes do I tick. Not from Ivy League MBA, not IIT engineer, decent intelligence. I will assume that I have, but patience and what did you say about mind?
I think mind control and
patience.
Control of temperament.
That is where the big cross comes,
important,
and that is where I know that I will never be a successful investor, so I'll do what I do, and which is to be here at CNBC TV18.
Just to give you an example about temperament control, what happens is that as you are seeing the things today, investors or analysts are focused only on the next quarter. Now, if you see the stock price movement, the moment the company comes out with results and the results are, say, 25% lower than either analyst expectations or, say, the last quarter, the stock would fall. And you get opportunities in these kind of falls.
Okay.
The only thing is that you have to understand the company well, and you have to know it should be a one-off event. It is not that, it's a falling kind of a wedge. So for that, you have to analyze and understand the company well. And it doesn't require rocket science. If you go through, say, the website of BSE, there may be a scenario that the company gives a news that, our operations were shut down because of a labor strike, which happened from 15th of February till 15th of March. So logically, you would know that the reason for fall in revenues is this reason. So sometimes they provide you very good opportunities to buy at lower levels.
Oh yes, and you know what? The market itself provided that with demonetization. You knew that it was a one-quarter hit, and anybody who bought into that made a lot of money. Ashish, thank you so much for your time. We'll have Q&A with Ashish as well, but we'll do that in a bit. For now, let me invite Surabhi back on stage to take this further. Thank you, Ashish.
Thank you.
Thank you so much, Ashish. As I was hearing both Ashwini and Ashish, I think the one thing that really stood out was this amount of noise in the market. I mean, Ashwini made a reference to that. If you're someone who follows the discipline of prices and technicals, then how do you make sure that you don't get swayed by noise? And that's something that even applies to value investing, that there's so much out there.